Hey, welcome to the Guaranteed Retirement Guy show. So, a question I get is what is universal life insurance? So, what is a universal life policy or an index universal life policy? So, a universal life policy is just a policy, is an insurance policy that allows you to have growth, typically a little bit more growth than a whole life policy might get you. It can be guaranteed, usually they are guaranteed, but some of them might be hypothetical just based off of whatever the index might earn over that time period. Now, for an index universal life policy, those are the ones I favor just because experience shows that they earn a lot more than universal life policies and a lot more than whole life policies. And so I'm going to focus on that today because index universal life policies are very, very popular for growth, for tax free income, and of course, death benefit. So if you're looking for an increasing death benefit, if you're looking for tax free income, and if you're looking for protection against market downturns while still having some decent growth, then you're in the right place. So I'm going to share my screen and I want to show you a little bit how these policies work. So I am showing a policy that I set up for myself at $500 a month for a few years, and then I raised it to $800 a month. So you'll see the $9,600 a year, and then you'll see $12,000 a year, so $1,000 a month, and then $1,500 a month later on. And so the reason why you want to set up, and you don't have to set up yours that way. If you want to set up for $500 a month and you just leave it there, you can. But I would recommend for maximum growth, and especially as we get older, typically we will earn more. And so we will throw more money into our investments. And so you want to set this up properly in the beginning so that your policy will give you the maximum amount of growth without limiting on what you can put into it. Because once you set this up, the limit is set. And that limit is that's specified from the modified endowment contract premium amount. And so you'll see up here, the maximum that I can put into this is $27,340 in any given 12-month period. So for instance, in the first year, if I put $6,000 in, but I happen to get a $21,000 inheritance, I can throw that in and I'm still under the limit. And all I'm doing is just compounding what's growing for me in the policy. Because remember, I've already set up the policy. I've already set it up with a very, very low death benefit so that the costs are low. And you don't have to do this. If you're doing it for a higher death benefit, then we would structure it that way. But typically when people reach out to me, they want a lot of wealth. They want a lot of tax-free income. And universal life policies can do that, especially index universal life policies. So you'll notice here, the accumulated value grows independent of the surrender value. So the surrender value is just what you can take on loans. If you want to take that money out in the form of a loan, you can do that. The insurance company will give you a loan based off of the value of your accumulated value column. So if your accumulated value is $100,000, you could take $100,000 out as long as your surrender value is at that point, which at 10 years it is. Before then, it takes a little bit of time to catch up, but it does. So, but people typically will take this out to finance personal things. They'll put money in investments, just a way for them to be their own banker without having their credit pulled. So it's a nice way to be able to kind of provide your own financing for yourself and at the same time grow your wealth, because while you do that, your accumulated value continues to earn interest, continues to grow because you're not withdrawing it. You're only taking a loan against it. So this is very, very valuable. And you can see, of course, at the end of 23 years of funding this, I'm going to take out $32,310 in tax-free income. So let's talk about the index. Okay, so right now, you'll notice that I have this in the Credit Suisse. And the Credit Suisse is not earning as much as the US Pay Center. So I'm going to change that. I'm going to take this out of there. And I'm going to put it into here. Now, and I can put this in the S&P if I want. You notice there's S&P focuses there, and a lot of people like that. That's just what they feel comfortable with. But I want as much growth as possible. And so, it also gives me an interest bonus, which is great. So that'll just give me extra earnings every year after policy year 6. So if I earn 10%, it's going to give me an extra almost 0.5% every single year. If I earn 0%, let's say the market is going down and I earn nothing, after 6 years, it's going to give me 0.45 guaranteed anyways. So pretty nice, little extra feature in there. But all right, so let's take a look at what this would look like if I just change the index. And of course, this is why I love index universal life policies, because they have the potential to earn a lot more, give you a lot more wealth. Okay, so we can see that accumulation value growing, same money going in, and now instead of $31,000 in tax-free income, I'm now taking $43,263 for my tax-free income. That's quite a bit better, not bad. So something to think about when you set up these index universal life policies is the index and what do you have access to. And there are a lot of companies out there. There's a lot of companies out there that will set these up, and the indexes are so-so, or maybe they only have caps, and they'll cap you at 6%, even if the index says 10%. Maybe the cost of the policy is too high. Depending on the company, there are companies out there that the costs are very, very high, the insurance costs. And so you want to make sure that the costs are low. But that's not the only thing. You have to make sure that the death benefit is low. You'll notice that my death benefit in relation to what I'm putting in here, I mean, I'm putting $500 a month. It's only giving me 418,000 death benefit. If you look up policies today for a 42-year-old like me, you can get a whole lot more death benefit for $500 a month. And then, of course, you'll notice it still stays around 500,000 in death benefit and goes down. The death benefit actually goes down because I'm pushing it down on purpose, even when I'm putting in $18,000 a year. So this is done on purpose because you want to make sure that your IUL performs like a low-cost index fund instead of a bloated mutual fund with tons of fees. So I set these up. I'm happy to set this up for you, or if you want me to illustrate what this would look like for your retirement, give me a call or schedule a call with me on my calendar. You'll see a link below. And if you want to get on my calendar, we'll work the numbers. If this is something that you're serious about doing for yourself, I can show you the very, very best companies to work with, as well as structure in a way where you can have more growth than you'll get anywhere else, but still have the market protection, the market risk protection from downturns, and be able to get that income that you're looking for. But if you're just looking for death benefit and you want as much death benefit as you can, we can set that up too. There's ways to do it all. And so I have access to all the companies, and it just really just depends on you and your goals and what you're looking for. So book a call, and thanks for watching the video, and look forward to seeing you soon.